Howdy, Jacob here. Today I'm going to do a little bit more in-depth analysis on PDD Holdings. We reviewed this company a little bit ago and we got to a price that looked very attractive today based on the estimations and assumptions based on the just numbers. So I did a further in-depth analysis into the company, and I'm going to go over some of the notes that I took from the quarterly reports as well as the 20F from the most recent year, which was actually last year. And I'm going to go through my new assumptions. Just want to let everyone know I hope that you do this in conjunction with your own analysis. This is not meant to be end all be all. This is just my assumptions and my evaluation. My goal is just for you to see the type of things that I pull from reporting, and so you can review in conjunction again with your own analysis. And so let's remind ourselves about the company's financials quickly. So we see that it's a very new company. It was actually founded in 2015, and they're already a $156 billion market cap. Their growth has been astronomical and has been going down slightly, but we saw a huge jump in 2023. But if you do look at it, this is due to Temu. Their Temu was introduced in the summer of 2022, and so there was very large increase in revenue there. But profit margin is up to positive now, 23%. Gross margin down from about 5 years ago, but is still pretty substantial for this type of business. In the internet direct marketing retail is 63%. That is insane. I mean, 23% operating margin, I think, is higher than Amazon's current gross margin. So Amazon's current gross margin is 16% shown here, and we just saw Pinduoduo's PDD Holdings operating margin of 24%. It's a little crazy to me. Um, Not a lot of history, so a lot of the assumptions we're setting, you're going to have to do your own discount rate that makes sense to you for taking into consideration the fact that we just don't have a lot of data. We can't rely on it necessarily as much as a company that's been very consistent for the last 10, 20, 30 plus years. So their balance sheet is very healthy. We see 22 billion in short-term investments, 8 billion in cash, and 22 billion in all of their liabilities, with less than a billion in short-term and long-term debt. So extremely safe balance sheet and free cash flow, very little capital expenditures compared to their immense cash from operations. And so let's go over some of the notes that I pulled from reviewing quarterly reports in the 20F. So their quarterly reports share the condensed statement of cash flows. So that's just to say that you won't see the actual free cash flow figures until the 20F comes out. So they share what the condensed cash flow line is basically just cash from operations, cash from investing activities, cash from financing activities. So you can't actually get to pull out the property, plant and equipment, or capital expenditures from the investment activities to calculate free cash flow. And it doesn't state free cash flow, at least in the last 8 quarterly reports that I looked at. So their co-CEOs, co-founders of the business, focus on technology for growth through R&D, high quality development, and focus on creating lasting value through strategic initiatives with sustainable and positive impacts. What I got from this is that kind of vague. I mean, when I look for when I pull this out for my in-depth analysis, I basically just want the company's CEO to have the same aspects that I am. And it looks like it is still a new company, but they have grown like crazy. They're still focused immensely on growth, which can be fine. It's just not the type of company that I'm usually looking at. I'm usually looking at a very boring company, so I want to see gushing free cash flow. The company is saying that we're focusing on efficientizing, making the company more efficient, increasing margins, um, buying back shares. But what we see here is just they're growing. And for a company as new as they are, I'm not surprised by this, but it does take different CEOs and management to grow a company versus sustain a company versus to keep it alive. And so um, we'll see how they're able to, go through phases beyond just growing like crazy, because you can't grow like crazy forever. It literally just doesn't make any sense since the world economy isn't growing more than 6% a year. It's impossible to grow 50% forever. And then one of their, a lot of their risks were pretty common. Nothing that really stood out. The only one that did was that They currently don't have business insurance coverage in China, and this is due to the Chinese insurance companies just being very new to the region, and so it's very expensive. And so they specified that they don't have it due to the fact that they were able to calculate the cost that what would incur versus the actual premiums that they would pay on those types of insurances, and they don't have it. So I just pointed out a couple business insurance that they don't have, which is general, product, commercial property, business income, professional, workers' comp, etc. Just stating that they don't have that coverage in China, which likely wouldn't be a huge detriment to their earnings and free cash flow, but definitely could hinder it in the future. They state that two IT businesses are taxed preferentially at 15% to 2023, and then another one is eligible through 2025, where the PRC income tax is usually 25%. The only thing is, I looked these companies up in the 20F, and I wasn't able to see what percent of revenue and earnings they are. So, kind of a waste, really. I wasn't able to see. Okay, is it 50% of earnings or revenue are coming from these, which I presume would not be the case since their IT revenue in general is not nowhere near that high. But it's just, I wonder, what's this 10% increase in tax liability ability to hit it? I'm going to assume it's less than 1 or 2%. So that's why they didn't really share these separately, share the revenue separately. So, but just pointing that out there, that could affect margins a little bit. I think the biggest one to think about that's not in here is just competition is going to be their biggest hindrance. Honestly, it's just there's so many competitors in this industry, and their margins are so high. I wonder if that's sustainable. So another quote is, "We currently intend to retain most, if not all, of our available funds and any future earnings to fund the development and growth of our business. As a result, we do not expect to pay any cash dividends in the foreseeable future." This is just saying it's going to be liable on the board, but currently and in the near future, they do not expect to pay a dividend. As of 2022, for their goodwill, essentially, they have 92 registered computer software copyrights, 1,600 trademark registrations, and 1,400 trademark applications throughout China, US, and globally. Their co-CEOs are only 43 and 39. I thought that was an interesting fact. Probably not good, bad, or ugly, but just pointing out that they're pretty young. So if they stick with this company, there could be a very long life of growth, since they definitely are good at growing a company from nothing. So we'll definitely see how they're able to sustain growth and then transform the business into more of a less growth, more strong, capable business. They have 13,000 employees roughly, with 5,000 in sales and marketing, 6,400 product development, 800 platform operation, 1,100 management and operation and administration. It's interesting that they have, the most of their employees in product development. That makes sense as they're a growing company. They're really trying to push those engineers and product developers to really shoot out some big boy growth. All their directors and executive officers just make up 1.2% of shares, but they have three large entities owning a large portion: Zhenghang, 26.5%, Tencent, 14.7%, and then PDD Partnership, 7%. Just pointing out that their capital expenditures make up less than 4% of their operating activities, so they are gushing out cash flow, and the reinvestment back into the business and retaining the business requires very little compared to the cash that they operate. And so I think the only thing I want to point out here is that Tencent having a 14% ownership is pretty big. Tencent, in my perspective, is one of the, if not the best capital allocators of any company I've ever seen, where the company's, the CEO will basically find things to reinvest with everything he has. So if he has $10 million, I mean, they have way more, but for example, $10 million, he'll go to the engineers with the greatest return on invested capital and be like, hey, you can reinvest at 30%. How many people would I have to hire to, would it be great? And they're like, oh, $5 million worth is all I could do. And then they go to the next one at 25% return on invested capital, go down the ladder until they can't reinvest any more of their dollars. And so for Tencent to have an investment here is, you don't know when they bought it, but I'm sure we could figure that out. But Tencent owning this company definitely makes me feel pretty solid, since they're huge, great investor and capital allocators. So my new assumption is basically just taking a greater margin of safety due to the fact that it is a Chinese company, it's very new, and then increase the margins variation with slight increase in share change. And we get to a price that's 40% off that right now. But hopefully you enjoy the video and have a great rest of your day.